Welcome to Charts and Trading, dear friends. I trust that you are blessed and that God is keeping you well. And even as you're taking time to go over these videos, I hope that you are blessed and I hope God is keeping you well. All these videos are made to the glory of Jesus Christ to glorify God our Father through the person, presence, and power of the Holy Ghost as He gives us inspiration as we are carrying out these videos. So one thing that's important for us to mention, as always, is that these videos are by no means to be taken as financial advice. You must always consult a licensed financial advisor, even as you're making decisions in the markets. We're just focusing on posting our analysis, and we don't even tell you what we do with our analysis. We are involved in the markets, and we have an involvement, and we do study the markets. And I'm drawing out of my understanding that I have as an economist. I got a bachelor's degree in business science from Monash University, and I'm drawing out of that knowledge of economics because we did learn about the financial markets while doing my degree. So it is out of that understanding, it is out of that knowledge that I'm providing this analysis to you. And once again, I'm not telling you the interest that we have or how we're placing positions or anything like that. This is purely just an analysis, and that's why we're analyzing everything, and whatever decisions you are making should be purely out of the advice you get from a financial advisor. This is just to give you some perspective. We're just commenting on the market's post-trading activity, and we're not doing a pre-market trading activity, because pre-market trading activity is almost for telling you what's going to happen, versus post-market activity where we're commenting and reacting to what has happened in the financial market. So take it as such, and it's important that you do so. So we're going to continue in the analysis of the financial market. So we have delved into different instruments from different markets. We've delved into the US stock market. We did that more deeply in the recent video where we looked at the Nasdaq 100 and the S&P 500 on that particular day, because we focus more on intraday activity, and we're not trying to cast out an analysis of what's going to happen. We're reacting to what has happened. We're focusing on reactive analysis versus predictive analysis. We're not predicting, we're reacting. So that's important. So now, once we having that established, on this particular video, we're focusing now on the currency market. We're going to analyze currency pairs that are measured against the US dollar, and then we're also going to analyze the digital currency market, and that one being also measured against the US dollar. So let's get right into it. So I'm going to just quickly copy and paste our checklist there. So the first thing that we're doing is that we're looking at liquidity. But first of all, trying to identify key liquidity sweeps at specific moments in the markets that establish the interest of either buyers and sellers. And then we're looking at the price point that established that particular liquidity sweep. And we're looking at the area that established that liquidity sweep, which now gives us the price area or the order block that established that interest in the markets. And then the next thing we're looking at the amount of and commitment of trading activity that is happening at those particular price blocks to tell us the strength of buyers and sellers at this particular point. At times from the volume, you can tell whether people are strong in their conviction or less strong in their conviction. And that's where you see a certain market, where you see certain commitment versus uncertain commitment. So people may commit with certain positions, but they may not commit as much capital to those positions as a result of the uncertainty that's probably happening in the market. So you notice around key times of the day and around certain moments, maybe before news is being released, you'll find that the volume dies down a bit. There are certain moments where there's low volume. And then the next thing we're looking at, once we're looking at the volume, is that we're seeing the evidence of that volume through what is known as volatility, which is the price reaction of trading activity. So which means we want to see a market that is showing a valuation of price that is evolving, because that shows the active buying and selling of that particular market. And it's the same thing in an economy. In the markets, it happens intraday, and also there's a lot of value being exchanged from the markets. But what we can still also see this in any other market, that there is always an evolution of price, in the sense that when you see a particular product gaining value, in order for the company to add value to that particular product, they will have to increase the price of that product in order to get more profit out of that particular value. So the higher in value a product becomes, the higher the price is going to become. And in order for the business to add more value, they're going to have to inject more expense into that, and then they're going to have to most likely charge a higher price for that. And that's why you notice that the price of a MacBook probably when it started is nothing compared to the price that it's at now. But then also the other thing also is that we do have key factors like inflation, that have also established the difference in value of, so it's not just the value of the products that have changed, but it's also the value of what the money that people are using to buy those products and services. So in other words, what I'm trying to establish is that there is always a depreciation and appreciation of value that happens in general economic trading activity. It just happens at a quicker rate in the financial markets because of the nature of the way that trading activity happens. So the way that there's volatility in this market is the way that there's volatility in every other market. It's just that the volatility will be measured out in probably at longer time frames because people are buying in a certain way. So you're not going to have moments, let's say maybe in the markets where, if there's a supply of MacBooks that are happening in the market, there is a certain amount of trading activity that is predictable, and that is going to also show that in order for a company to properly value or to properly establish the data for their trading activity, them selling MacBooks, Apple selling MacBooks and people buying MacBooks, are going to have to see how that is happening over a quarter, because from a normal buying and selling market in that particular MacBook era, you may have people buying more at a particular time and people buying less at a particular time. So it's similar in the markets where you're looking at key times in the day where you're going to have more activity versus less activity. So once you see that volatility, the next thing that we're going to see in the data points that we're trying to see market structure shifts, breaks of structure that happen as a result of liquidity sweeps based on the volume and the volatility of the trading activity that's happening. So I hope that makes sense, the volume and the volatility of trading that is happening at those moments in time. So I hope that makes sense. So this is the pound against the US dollar, right? And we're gonna first of all analyze this being a European asset. But first of all, we're gonna try and analyze what was happening when London session started. Let's try and analyze that and see what was happening when London session started. So when London session started, which is at this particular point here, we're trying to identify key sweeps of liquidity, right? So whenever you are trying to identify a liquidity sweep, you're trying to also go first of all see the kind of market environment that was established before a market sweep happens or before a liquidity sweep happens. So what we can definitely see when London session started, actually from Frankfurt, which is where we see European traders starting to enter into the market, we can see that the market here before Frankfurt started, we can see like a bullish market right here. We can see an activity of buyers pushing the market up. It's a combination of buyers and sellers, but predominantly buyers are injecting more capital, moving the market up. But then what we see is a liquidity sweep that sweeps all this. So we see sell side liquidity coming in and sweeping all of this, establishing that there is a selling point that is coming in the markets, that the markets are now starting to sell after this buying activity. But then we can also still see, actually, what we can see here, this also gives us an important principle, is that when we're analyzing the stock market, we predominantly looked at the price transition from pre-New York to New York session. But when you're looking at currency pairs like pound, euro, which particularly draw their liquidity or their trading activity starts in Asian session, you're also trying to analyze what was happening in Asian session. So while this liquidity sweep gives us a smaller range of trading activity, you will notice that despite this liquidity sweep here, this particular price here did not hold. It still or there was still in some form a liquidity sweep that drove price here. So which liquidity sweep matters? It's the liquidity sweep based off of the previous data of trading activity. So the liquidity sweep here that we're paying attention to is from the starting of Asian session. So what we can see is that we have a liquidity sweep here. You only start to pay more attention to the liquidity sweeps in London session once they're aligned with the liquidity sweeps in Asian session. So Asian session, we had a liquidity sweep of buyers here, revealing that this was a seller's market from the start of the day. And then after that, we have to now look at the price of origin for the activity of selling that started the selling activity in the markets. So what we can see is that the price point of origin, or the price point that started the selling activities here. So this order block now becomes a liquidity pool for sellers. That if someone is coming to sell the market, they're going to sell the market efficiently if they sell at this price. But if they sell at any other price, there's a high chance that they're only going to have the kind of market or the kind of valuation continuing for a small amount of time, and there may not be a significant value change that validates the capital or the risk that they're placing to get into that position. So you can see that the continuity of selling activity only happened once the liquidity pool from Asia was tapped in, which was just before London session started. So we can see that sellers were drawing out of the volume of trading activity, the liquidity of trading activity, and the volatility of trading activity from Asia. So we can see all of this liquidity now, this selling liquidity being taken out, yes, but then being taken out only to this point here, which now means that from a continuity of trading activity, the buyers here are most likely going to be swept out at the beginning of London session. And this is what now we begin to see. And don't think too deeply about the lines that you're seeing. Don't try to say, okay, no, that looks like a square. So when there's a square in the markets, the only thing that you're trying to focus on is price and buyers and sellers at those specific prices. You're trying to look at the price and the volume of trading activity that's happening at those prices, right? Price and the quantity of trades that are coming in at those prices. So you're looking at the price of a particular instrument, and then you're looking at the quantity of buying and selling that's happening at those particular prices. So what we see here is that this particular price block became a price of interest and a liquidity pool, a place where the market is going to be in temporary equilibrium before it continues in a bearish direction, which was set by the Asian market that also brought about the same kind of trading activity into the market that started when Asian session started. So we can see that sellers of the pound against the US dollar took a position here at the beginning of London session and sold the market up until this price point. For what reasons? We're not sure. There are different reasons, but what we can see is that this particular price point becomes the place where the selling is exhausted. And what kind of position do we have here? So we had a 2 pip price range, and then we had about a 20 pip price movement from that particular price. So we can see that was a 1 to 10. This was a 1 to 10 risk to reward opportunity, but it was very short-lived. It only happened for an hour, and then the market now went bullish. As we can see, the market now started to go bullish. But this was a very good opportunity to point to see in the markets. So this was an opportunity that we have taken note that happened in the markets from the day traders of London session. So this was a 1 to 10 risk to reward position. So what a kind of trade, what a trade that was, what a trade opportunity that was. Okay, so we're gonna comment on London session specifically for this particular instrument, and we'll go to the next instrument. So that's for pound against the US dollar. So now let's go to Euro USD and see what was happening. So for Euro USD, since we looked at London session, let's see how New York session was for Euro USD and see what kind of opportunities people are capitalizing on as New York session started, which is what they call the overlap between London session and New York session. So New York session starts while London session is still active, and that overlap does generate a certain level of liquidity in the markets and a certain amount of volume in the markets. So let's look at, once again, key price points. So pre-New York was here, and then New York started right about here, right? So once again, drawing out of the same principle, we're gonna draw off of the trading activity that was happening from the previous session. So people entering into the New York session to trade, particularly US traders, will be introduced at this particular point. We can see, first of all, from London session, that there was a sweep of this liquidity here. The sweep of sell-side liquidity confirmed with a break of structure here, because we had sellers all the way up into this point, but then we had a sweep of liquidity here. And then after this sweep of liquidity, what we can see is that the underlying price block, the underlying price of interest, was this particular price of interest that originated this buying activity here, that swept the liquidity here. And then once this liquidity here was swept, this particular price point becomes a price point of interest that attracts a certain level of volume, that injected a certain level of volume into the market that was enough to sweep liquidity, confirmed by the volatility of the price, the change of price from this point to that point. So now, once that has been established with that market structure shift, that price point of origin, which is more of like a reversal in a sense, because the market structure shift is here specifically, it took out this liquidity as well. But the reason why we're seeing here is that we see that this resulted in a market structure, more of a reversal market structure shift. And then we can see that once price returned to this particular order block here, and I'll just mark that as an order block so that we can see. Once it returned to this order block here, this order block now became an equilibrium price for the continuity of buying that was happening. And then once the price went there, we can see that buyers took a position here to buy the euro against the US dollar. And this was about let's say a 6 pip move, a 6 pip price range, and then it was about a 30 pip move. So what we can see is that there was at least a 1 to 4 on this particular move, at least a 1 to 4 on this particular move, more of actually a 1 to 5 if it's a 30 pip and it's a 6, yeah, 1 to 5. So let's just mark it as a 1 to 5. 1 to 5 probably was marked at this point here. So we had a 1 to 5 trading position that people took at that particular price point. Okay, so I hope these concepts are making sense. Alright, so we had that particular move coming in the markets. So now let's go into another instrument from the digital currency market, because we've delved into the normal currency market. There's still financial instruments per se, but let's go into the digital currency market and see what was happening. And also with this one, we're going to focus specifically on New York session to see what was happening there. Okay, so where does New York session start? New York session starts about, not much to write home about though. Okay, let's try and draw out of London session. Let's see if there's any transition from London session. I'm trying to see if the order blocks were being tapped into here, because we have, obviously we have a buyer's market that's being established here, but what we're also seeing is that there isn't really any return to order blocks, which to me kind of signals a bit of a randomized buying and selling, not really an equilibrium market environment where certain price points are met as agreed prices, because you want to be in a market that's focusing more on an equilibrium based market. Okay, so we do have an order block that was used as an equilibrium price block. So we're gonna mark this area here, and let's see, probably from the 5 minute we may have a bit more detail on that order block. Yes, we do. Okay, so what we can see similar here is that for the crypto market, just before Frankfurt session started, just at the end of Asian session, Sydney session specifically, we can see that there was a sweep of the liquidity of sellers here, confirmed by this market structure, confirmed by this breaking or the sweep of the buyers here, and we can see the volume that is generated out of this price block and the volatility that shows the price change once that price block was established. And then once the day goes all the way from London, we see that the market comes back to this price area here, and that price area now becomes an equilibrium price for trading continuity and focusing more on continuation patterns. So we can see there was a position there, and that position generated a certain level of trading activity. This was probably more of like a 1 to 2, 1 to 3 risk reward position, but at least we've seen the concepts play out. So that's what matters most in these markets, is to understand what I'm going to now put here as the underlying factors. Is we're looking at that: liquidity, volume, volatility, market structure, equilibrium price. Liquidity to establish interest and price, volume, amount, commitment of trading, volatility, price reaction, markets structure, direction, and then price